Welcome back to the Everything Financial Radio program. I am your host, Dennis Tubbergen. We are chatting today with Mr. Harry Dent, publisher of the Survive and Prosper newsletter. And Harry, in that newsletter, I just want to jump back in. You talk about cycles, and you mentioned them briefly in the last segment. You talked about a geopolitical cycle, a spending wave cycle, and a commodity cycle. Let's just start with a geopolitical cycle. Can you explain what that is? And ultimately, listeners are going to be very concerned about what the consequences might be.
Yeah, I found back, especially when we were forecasting a second stock bubble, in the early 2000s to 2007, and we did get the boom. We got earnings, everything we thought we were going to get, and then stocks just didn't bubble as much as the 90s. And then I went back and said, well, what was different in the roaring 20s when we had two tech bubbles and a greater bubble to follow the first? And I found out, the geopolitical cycle was different. Commodities were different. So I discovered two new cycles. And the geopolitical cycle simply is about every 18 years, we switch from having a positive geopolitical cycle to a negative and then positive again. Example, 1983 to 2000. Inflation was low and falling. No wars. We had one war for 100 hours, the first Iraq War. No major global geo conflicts or dictators. It was just a good time. There was no risk in the world, and everything else was good. The spending wave was up, so that was a great period. But starting in 2001, as we all know, not only did we have the tech wreck get really nasty that year, but we had 9/11, and things have never been the same. We've had one war after the next, the Iraq War, and then the Afghan War, and one country, dictators fall, civil wars, now with banking crisis around the world. That 2001 to 2019 is the next 18-year negative cycle. Now, the spending wave was still good up to 2007, so stocks went up, but they didn't go up as much. I found that stocks are valued about 50% lower in these higher risk periods. Now the spending wave turned down in 2008, so now we got the geopolitical and spending wave down, but you also have a commodity cycle. That peaked in 2008, a little ahead. It's about a 30-year cycle that was due to peak more around 2009. It peaked in mid-2008, peaked again a little lower in early 2011, and commodity prices are pointing down. So from 2008 to 2019, all three of these cycles point down. Then we have one more important cycle, the decennial cycle. Every 10 years about, we see downturns for a couple of years and more. And I recently found out that didn't work well. It's usually in the early part of the decade, the first 2 to 3 years. I recently found this is more connected to sunspot cycles, and this sunspot cycle recently has been more irregular, and it's peaking here in late 2013, and it points down into late 2019. So we have all of our major cycles pointing down from, say, early 2014 to late 2019. So that, to me, is when we're going to see the next great crash, the next depression, the deflationary period. I think governments are simply going to lose control of the economy and interest rates for their stimulus. And again, interest rates are already ratcheting up. That's the sign that the beginning of the end that we've been waiting for. So I think this crisis is going to start in the first quarter next year, and we're going to be in a recession by the second quarter next year.
Harry, in your research of these cycles, is there any correlation between how far you are in the cycle, how far the cycle has advanced, if you will, and the intensity of the consequences?
Well, yeah, as a general rule, especially when the spending wave turns down or the 10-year or the sunspot cycle first turns down, you're usually very highly overvalued in markets and highly stretched in debt and everything. So the early stages, usually you see the worst, like from 73 to 74 in the last crisis when stocks finally collapsed, 1930 to 33 when they first collapsed. Now, stocks were down off and on all the way into 42 and all the way into 82, but the worst came when markets first crashed in early cycles. So that would, in the spending wave peak, and we saw a big crash in 2008 after that. Well, the next one comes when the sunspot cycle turns down. Probably 2014 to 15 would be the most dangerous time when you look at that. The commodity and geopolitical cycles aren't quite as sensitive to that effect.
Harry, I'm putting myself in the shoes of a listener that says, here's this bright economist talking about a sunspot cycle. How do sunspot cycles relate to what's going to happen in the economy and my money? Could you give them an explanation?
Well, first thing, I was given a presentation, and I mentioned that, and I said, I know this sounds kooky, But somebody got up after that and said, and raised their hand and said, look, I work in an emergency room, and anybody in an emergency room, any policeman will tell you when you have a full moon, you get way more accidents, way more people thrown in jail, all types of stuff happens. Well, think about the sun, the biggest thing looking at us, and when we get higher solar radiation, that's literally energy. That's what happens. The sunspot cycle tends to go up for 4 to 5 years and then down for 5 to 6 to 7 years. That would impact things even more than, say, a full moon. So you tend to get, it's bullish for the economy more when the sunspot cycle is pointing up, and the last time it's pointing up was from early 2009 to late 2013. And guess what? The stock market came back. Well, it's pointing down from 2014 to 2019 approximately. NASA tracks this, and many universities, because it is so strong, it affects our infrastructures and satellite systems and things like that. So if it can knock out satellites, it could certainly make people a little more energetic or a little more positive or a little more bullish or something. So I don't know exactly what it does, but I've been tracking this 10-year cycle for many decades. Ned Davis came up with it, and he averaged it over the last century. It worked every decade. The early 60s, early 70s, early 80s, early 90s, early 2000s all saw stock crashes and recessions. Only in 2010 to 12 did it not happen. I'm thinking, gosh, was it just the Fed stimulus? And then Paul McCulley, who's a major fund manager past at PIMCO, said early 2000s the sunspot cycle is what saved him from that crash. So I said, well, gosh, I should look at this. I'd heard of it before. I looked at it. I tracked it back hundreds of years. I tracked it over the last decade. The correlation is just too damn good to ignore.
Fascinating. Harry, you talked in your most recent Survive and Prosper newsletter about trouble in the banking sector. Give us your take on the health of not only banks in the United States but worldwide, and I'm thinking about the high level of derivatives exposure that 4 big U.S. banks have, and my understanding is it's greater now than it was in 2007.
Yeah, our banks are all connected through all this derivatives. Everybody's insuring each other against losses with no collateral, so it's basically BS. And we've got high debt ratios all around the world. Governments have not allowed debt to deleverage, have not allowed banks to fail. They prop them up. All this QE is not going to Homer Simpson. It's not going to most people. It's going to the banks. They cover their losses. They up their reserves to keep them afloat, and then they speculate with the rest of the money since they're not lending it to us very much. So this is a whole casino. They turn our banks into casinos. They're keeping the bubble going. So banks look healthy. Well, if $10 trillion of free money, of course banks look okay. Without that money, we would have seen a 1930s breakdown of the banks because the derivatives, the debt ratios are higher than they were in the roaring 20s. All this stuff is way off the charts, so they're not healthy at all. All it takes is a trigger for the next crisis or for the governments to be forced to stop stimulating and giving banks free money, and you'll see what happens. These banks are going to show themselves to be unhealthy very quickly. In Spain, loan losses are still going up. Real estate prices are still falling. I think Spain could be one of the triggers for the next global crisis because their banks are just going to fail.
Harry, what you just stated, if you're a listener out there, that's sobering to say the least. It's downright scary. What advice would you give listeners about personal banking?
Well, the key thing, spread your money around some, but the key thing is have a minimum in like your checking and don't have money in savings accounts. You need to have any excess money beyond what you need to transact in your business or your life in an investment account in your name. That's something a bank cannot lend against. You put money in a savings or checking account, yes, insured by the government up to $250,000 or whatever, but what if everything falls apart? Are they going to be able to make good on all that? They're going to end up paying the less income people, and affluent people are going to get canceled just like everything else. You have to have an investment account. They can lend against that saving and deposit checking account. They can't lend against your investment account. So that's yours. It may get tied up for all the problem. That's yours. If you have it in safe stuff, you'll be able to access that money in a crisis and not worry about, is the government going to make good on their pledge for my checking account? Maybe they will, maybe they won't.
Harry, I want to ask you about your book here before we end the interview, but before I do, you said have your assets in safe stuff. Give our listeners a couple examples, would you?
Well, one thing, everybody wants to be in gold and silver. We've been saying, no, gold and silver are inflation hedges, not deflation hedges. And debt deleveraging, like we saw in 2008 and 9, causes deflation. And yes, gold and silver crashed in late 2008 when everything else crashed. But we went up the U.S. dollar compared to other currencies. So there's an ETF, for example, UUP, that tracks the U.S. dollar versus our trading partners' currency, which is mostly Europe, Canada, Mexico, and some China and Japan. And that went up 27%. That the ultimate hedge, when we have a crisis, debt deleveraging is good for the dollar. We destroy dollars when that happens. But also the U.S. is the safe haven in the world, not China. They're going to have social unrest beyond anything you imagine. Europe already has social unrest and deep problems. U.S. is the safe haven, and so the dollar, betting on the dollar going up, first of all, it's been generally going up since the crisis started in 2008 without a lot of volatility, so you're not going to get killed like the stock market if it goes against you. And if we do have a crisis, that's the best hedge. The other thing, just be in short, safe-term CDs and Treasury bills. Don't look to make hardly any money on it. To preserve your cash when things crash. And if you're more aggressive, you can put some percentage of your portfolio short the stock market. In other words, people can buy the S&P 500 by buying an ETF like SPY or a fund like that, or you can buy a short fund, or SH is an ETF that bets on the S&P 500 goes down. Maybe just put 20-30% of your portfolio short stocks. That hedges you for anything else you're holding, real estate and stuff. And if stocks go down, you make money.
Well, let's talk, Harry, about a book that you're working on that I understand will be released around January of 2014. You can correct me if that's not the case. It's called The Demographic Cliff. Explain to the listeners the premise of that book and the work you're doing.
Yeah, all this stimulus, and people just think governments can keep stimulating. What we make the argument is, look, the governments are fighting a continued progression of countries going off the demographic cliff, which means the baby boom in their country peaks. Not only does it peak, but it's followed by a smaller generation in most countries. Japan has been down for 2 decades, partially because of endless stimulus that puts you in a coma economy and kills the golden goose, but partly because the next generation just isn't big enough to lift them back off the ground again, especially in house buying and stuff. So we look how that's going to progress around the globe. Japan was first back in the early to mid-'90s. They peaked way back then and went down while the rest of the world boomed. The U.S. and North America were second in 2008. We started heading down. Europe is in a plateau in demographics and doesn't start turning down until next year. If Europe's in trouble now, how much trouble are they going to be when their demographics turn down? And guess which country leads the way down? Germany, the one country that's supposed to hold up the whole place. Germany, England, Switzerland, and Austria are the first to turn down in Europe, and then Southern Europe, which is already in trouble, follows them. And so demographics are only going to get worse. Governments are going to have to stimulate more and more for a whole decade if they want to keep the economy crawling along, and we're going to have such high debt and deficits and Federal Reserve balance sheet that we're going to have a disaster. In other words, it just can't happen. We can't have a massive stimulus program escalating for another 10 years. At some point, the stimulus is going to fail. At some point, people are going to lose faith in stimulus. And you got to remember, in Europe, in 2012, they had their biggest stimulus ever. In early 2012, mid-2012, they fell into a recession anyway. There is a point where more and more stimulus, like more and more of a drug, just doesn't work anymore, and bam.
Well, we're going to have to leave it there. Our guest today has been Mr. Harry Dent, publisher of Survive and Prosper. It's a free newsletter available at harrydent.com. Harry, thanks for your time today. Hope you'll come back.
Sure, Dennis.
We will return after these words. Stay with us.